Hi. Welcome back to Cheryll Trades Leaps. Today we're talking about something almost every trader experiences, but very few truly understand: psychological resistance levels. Or in simple terms, why stocks often struggle around round numbers. So, what you'll learn today. First, we're going to talk about why price stalls at round numbers, because this behavior happens constantly in stocks, crypto, and indexes. Then we'll talk about how institutions quietly exploit human behavior around these levels, because the market is deeply connected to psychology. And finally, I'll show you how understanding this can improve your leaps entries and help you become more patient near emotional market extremes. Once you understand where human emotions cluster, you start understanding where liquidity lives, and liquidity is what institutions care about most. First, let's talk about how the brain loves round numbers. So let's start with something simple. The brain naturally loves round numbers. Levels like 50, 100, 500, and 1000 feel important to people emotionally, even if technically they're just numbers. Think about how humans naturally estimate things. People don't usually say $97,342. They round it to 100,000. The brain prefers simplicity. Same thing in trading. People don't naturally focus on 48.7. They focus on 50. Our brains love shortcuts. Psychologists actually call this a cognitive shortcut. The brain simplifies information to reduce mental effort, and traders do the exact same thing. That's why stop losses, take profits, and buy orders often cluster around round numbers. And once enough people focus on the same level, it starts becoming psychologically important. You can see this everywhere in the market. In crypto, Bitcoin near 80,000, Ethereum near 2,000. These levels attract huge attention emotionally. Same thing in stocks. Nvidia near 200, Tesla near 400, SPI near 700. People naturally become emotional near these levels. And when millions of traders focus on the same level, that level becomes real, even if, technically, it's arbitrary. Now let's talk about what happens when all these emotions cluster together. This is where liquidity forms. Large institutions cannot buy or sell massive positions easily. They need liquidity on the other side. That's why these emotional levels matter so much. As price approaches a major round number, people react emotionally from all directions. Some traders take profits, some short, some buy breakouts. Everyone starts reacting at once. And the result is a giant cluster of orders around one price. That's what creates liquidity. And institutions love liquidity, because liquidity allows large funds to move huge amounts of money more efficiently. Round numbers often act like a vacuum before they become resistance. Price gets pulled toward them first, then struggles once it arrives. Now let's talk about the invisible wall most traders never notice. Price often weakens before it reaches the actual round number. This is called the buffer zone. Many beginners think resistance starts exactly at the level, but markets are usually more subtle than that. Institutions often start selling earlier, maybe 98, 98.5, 99. They front-run human behavior. This is why I watch for smaller candles, weak momentum, failed breakouts, and long upper wicks. These are often early signs that order flow is changing. And that slowdown is usually not random. It often means buyers are losing strength while sellers quietly step in. Now let's look at signs of a real buffer zone. One clue is shrinking candles. Momentum starts slowing as price approaches resistance. Another clue is unusual volume behavior. Volume may suddenly weaken or spike strangely. And long upper wicks often mean sellers are stepping in early. That's an important warning sign. Now, let's talk about something retail traders hate: the stop hunt. First, understand this. You didn't get personally hunted. The market simply moved toward where liquidity was sitting. Price briefly breaks above resistance, and everyone gets excited. Then suddenly, price reverses sharply, and breakout buyers get trapped. Algorithms know where retail orders usually sit, especially near obvious round numbers. So price spikes upward, absorbs liquidity, then reverses once those orders get filled. So how do we tell the difference between a fake breakout and a real one? Fake breakouts often spike quickly, have weak volume, and reverse immediately afterward. Real breakouts usually hold above the level, retest successfully, and maintain momentum afterward. That confirmation matters, especially for leaps entries. Now let's look at real-world examples. You see psychological levels everywhere: crypto, stocks, indexes, earnings season. Media talks about these levels. Retail traders obsess over them. Algorithms monitor them. And together, they create real resistance. This creates a self-fulfilling cycle. Media highlights the level. Retail traders place orders there. Algorithms react to the liquidity. Then price action reinforces the level again. Attention creates liquidity. Liquidity creates reactions, and reactions reinforce the level. Now let's talk about the actual edge: probability. The goal is not predicting perfectly. The goal is adjusting probability. Historically, the more significant the round number appears, the higher the probability of temporary hesitation or pullback. As price becomes extended, euphoric, and crowded, risk increases. Can price still break higher? Absolutely, but risk versus reward changes. And overpaying during emotional excitement is one of the biggest leaps mistakes traders make. This is why I become more cautious near major psychological resistance, especially when momentum overheats, volume weakens, and everyone suddenly becomes bullish. So how do we trade this intelligently? I usually wait for one of two things. Scenario 1, a real breakout with confirmation. Or Scenario 2, rejection and pullback. The key is patience. Don't force trades emotionally. One mindset shift changed everything for me. Instead of asking, "I need to buy now," I started asking, "Where is liquidity trapped?" That changed the way I see the market. Now, let me explain how I personally approach leaps near these levels. I become much more patient when stocks are flying into resistance, social media becomes euphoric, call buying gets crowded, and everyone suddenly expects a breakout, because those moments often lead to emotional overextension. And better entries frequently appear after the excitement cools down. At the end of the day, round numbers are magnets before they become walls. Cash is a position. Patience is an edge, and the best traders wait for confirmation instead of chasing emotion. Because I don't trade the news, I trade the reaction. And if you enjoyed this video, subscribe to Cheryll Trades Leaps. I'll see you in the next one.